Jenny lives in Australia and buys running shoes from an overseas seller for $300, which is considered a low-value good. The overseas seller is registered for GST in Australia and is required to remit GST on the transaction, as the purchaser is an Australian consumer. The seller increases the price to include GST, and Jenny will be liable to pay a total of $330. The GST legislation contains specific provisions dealing with situations where an overseas entity provides goods and services to Australian customers. These provisions cover the supply of low-value goods, the supply of intangibles and services to enterprises, as well as the supply of intangibles and services to consumers. GST is not generally levied on cross-border business-to-business transactions, where an overseas business sells low-value goods, services and intangibles to a GST-registered Australian entity. However, the overseas business may be subject to GST to the extent they supply to non-business customers in Australia. One of the conditions for a taxable importation is that the customs value of the goods is over $1,000. This previously meant that many consumers that purchase goods from overseas, usually through online transactions, were able to bring in items costing less than $1,000 without paying GST. However, the law now requires the sellers of such low-value goods to potentially register and pay GST. Under these laws, non-resident suppliers of low-value goods will be liable to 10% GST on such goods that are supplied to consumers in Australia. This will, however, only be the case where the supplier's taxable supplies to Australia exceed the annual threshold for GST registration. Note that for GST to apply, the goods must be supplied to an Australian consumer, which is an entity that is not GST registered, or if the entity is registered, the goods are not acquired for a creditable purpose. These provisions in the legislation potentially place the GST liability with the non-resident vendor of the goods. However, if the vendor is not the party assisting with the delivery of the goods, then the liability can be shifted to the electronic distribution platform or redeliverer. Sally owns Low Prices, an Australian online seller, as a sole trader and is registered for GST. Sally seeks the services of cybersecurity experts from a multinational company called Cyberweb to assist with her business website. Cyberweb is not an Australian resident and does not have a permanent establishment in Australia. As part of this process, some employees of Cyberweb spend time in the Sydney head office of Low Prices. In this scenario, the supply by Cyberweb is not subject to GST. Under the GST legislation, a supply of intangibles or services from an overseas entity to an Australian consumer may not be connected with the indirect tax zone, resulting in no GST liability. Where the supplier is a non-resident and does not make a supply through an enterprise carried on in the indirect tax zone, and the supply is made to a GST-registered Australian enterprise that is not using the supply solely for private purposes, GST will not apply. This exception also applies in some other situations involving supplies by non-residents not carrying on an enterprise in Australia. Where there is a supply of intangibles or services that is not connected with the indirect tax zone, but is not fully used for a taxable purpose, then a reverse charge needs to be made, meaning the acquiring entity will be liable to pay GST on the transaction. However, an input tax credit will be available to the acquiring entity for the proportion of the transaction that is used for a taxable purpose. Let's change the facts to the previous example slightly and assume that the owner of Low Prices, Sally, uses the technology provided by Cyberweb primarily for the business of Low Prices, but also partially for her own private website. Sally estimates that the private use percentage is 5%. In this situation, Sally would be subject to a reverse charge and would be required to pay GST on the amount charged by Cyberweb. However, as Sally used the services 95% for a creditable purpose, she could then claim an input tax credit for 95% of the GST payable due to the reverse charge. Another area of the cross-border GST provisions is popularly called the Netflix tax. This imposes a tax where a non-resident supplies intangibles and services to Australian consumers. This covers such items as sales of online movies, TV show streaming, software downloads, and data storage. The relevant provisions are similar to the importation of low-value good provisions. These provisions impose a GST liability on non-resident suppliers of services and digital products. They do so when such entities supply services or digital products to Australian consumers, and the annual value of the entity's taxable supplies into Australia exceeds the GST registration threshold. As is the case with the low-value imported goods provisions, if the supply is made through an electronic distribution platform, it will be the platform that is liable for GST. To recap, the supply of low-value goods, intangibles and services by non-residents to Australian consumers can lead to a GST liability for the supplier. If the supplier meets the required turnover threshold for GST registration, the supplier will generally add GST to the purchase price and be required to remit the GST. However, the supply of intangibles and services by non-residents to registered Australian enterprises can, in some situations, escape GST. Here, the Australian enterprise that is registered for GST and acquires the supply for a creditable purpose would notify the supplier of their non-consumer status, typically by declaring their ABN, and GST will not be charged on the transaction.